On the line with me today is my guest. His name is Doug Marshall. He's a returning guest. He's been on a couple times before. He's a commercial mortgage broker in Portland, Oregon, and he's with Marshall Commercial Funding. Doug, welcome back to the program.
Well, thank you, Darren. I enjoyed the previous two times that we've talked, and I look forward to doing it again.
Likewise. I think it's always good to talk about financing and the issues that are involved, and always good stuff. Hey, Doug, before we get started here, if you could spend just a second and remind the listeners about you and what you do, and start from there.
Well, I've been financing commercial real estate for about 30 years. And I've been an investor in commercial real estate for about 10 years. I own my own company. It's Marshall Commercial Funding. You can find it on the web at marshallcf.com. And I've been self-employed for about 14 years now.
Got it. And today we're going to talk about some mistakes that investors make and how to avoid or the mistakes to avoid. And yep. I'm sure there are many, but these I'm sure will resonate with our listeners, and definitely some things that probably many have made, and I know I'm guilty of many of them. But why don't we start? What's one of the mistakes investors should try and avoid?
Well, then backtrack a bit. I've seen over the 30 plus years I've been in commercial real estate, I've seen these five mistakes made on a regular basis by investors. In fact, I've made some of these mistakes. And if you're listening to this podcast, I would tell you to avoid these five blunders at all costs, because they can cost you big time. And the first one is analysis by paralysis, and that's getting bogged down in the minutia. Good news is that there's only a small subset of investors that do this, but when they do it incredibly well. This type of investor believes that the more information they get on the property, the better will be their purchasing decision. Now, it sounds logical, but unfortunately, in most instances, that's not the case. As the saying goes, these investors, they can't see the forest for the trees. They're way too involved in the details of the purchase that they forget the big picture. So on the other hand, a savvy real estate investor, they don't get caught up in the minutia. They generally focus on a very, very small subset of issues to get comfortable with. And if they get comfortable with those issues, this determines whether or not they will make an offer on the property. And not only does the detailed-oriented approach complicate the buying decision, it greatly enhances or lengthens the time necessary to come to a decision. Many times, another buyer comes along while Mr. Paralysis, by analysis, continues slogging through the details and steals the property away from him. In reality, the seller is just tired of all the nitpicky questions the original buyer has bombarded him with, and he's relieved that someone else is swooping in to save him from the first buyer.
Right. Let me ask you, do you have any sense, is that more typical of a new investor?
No, I think it has to do with personality bent more than anything. I've seen very experienced investors do this, and I've seen the beginners do it as well. I think it has more to do with a person's personality. A person who likes getting into the weeds, and there's nothing wrong with that. But at the same time, generally, as a rule of thumb, there are like 4 or 5 things that you can look at, and each person's list is a little bit different. And I've found over the years that the really experienced investors that have done extremely well in commercial real estate almost do it by the back of the napkin approach, a 30,000-foot elevation look, and coupled with gut instinct, and they are right most of the time, and surprisingly so. Much more, of a a simplified approach than even I would take, because I like getting into the weeds too. I kind of enjoy it. That's my personality bent. But they have kind of figured out what they're looking for, and if they can check the box on these 4 or 5 things, they generally make the right decision. And it's usually a fairly simple approach.
Right. No, I think that's clearly it's easy to get tangled up in all the details and go through them and keep going through them and run another pro forma or, on it goes. But I like what you're saying about, having just a kind of a finite set of criteria. And I think that's probably, a good indicator, period, if somebody knows what they're trying to accomplish. And I know, I've been in those analysis where you just keep going and going, and when you back out of it, I think if I were to reflect, I would say that probably there was something incongruent in there, and that was probably more the struggle as opposed to, and I didn't know what that was. Otherwise, I probably would recognize this is not a good property for me.
Yeah.
That's good. All right. So what's mistake number 2?
Well, Darren, the second mistake is kind of like the opposite. It's of the first mistake. It's the investor who only does a fairly cursory due diligence on the property. And this usually takes 2 forms. The first mistake is not reviewing the historical operating statements and the current rent roll carefully. It's not uncommon that a property's profit and loss statement is not transparent to the average reader. And there could be lots of information hidden in the property's operating statements. It happens all the time. And they need to be teased out by asking the seller good, penetrating questions. For example, if it's not obvious, and it's surprising to me how many statements are not, ask the seller what the vacancy rate has been over the last 3 years. Surprisingly, there are many operating statements that don't show vacancy. All they show you is the amount of income that they received. They don't tell you what the gross potential was, so you really have no idea what the vacancy is, and you really need to know that. Another thing that you need to really take a good look at is the operating expenses. Is there 1 or 2 operating expenses over the years that's either increased dramatically or decreased dramatically over the previous years? And you need to ask the seller, why is that? And it might be something that's very important to making a good, intelligent decision on buying the property. And then finally, there oftentimes are one-time expenses in the operating expenses that should be removed from the projected operating budget. For example, somebody might have replaced a roof and they expensed it instead of capitalized it, and that distorts adversely the operating expenses. So it's in everybody's best interest to be able to take that out of the ongoing operating budget. Those are just a few of the questions. Just depending on what is revealed by the statements, you'll just have to figure out what is the appropriate question. The second mistake is only doing a cursory physical inspection of the property. If you're buying apartments, you need to have your building inspector inspect every unit, and the roofs, the laundry areas, the attics, the crawl spaces, etc. Now find a well-qualified inspector, somebody that has a good reputation to represent you, who can provide you a detailed report of the physical condition of the property. It's very important to be able to find out up front what those additional deferred maintenance expenses are, so that you have a handle on what's a realistic price that you should offer for the property.
No, I, again, guilty as charged. I've clearly thought I knew something, only to find out or learn another lesson as I went on. And I'm kind of curious, do you think that's, again, kind of a, well, and I don't want to say the cursory, because I don't want to say that everything was cursory, but there was a point in a recent property where there was a question, and after, engaging some other individuals and professionals, we agreed to act this way, as opposed to when the question was asked, do you want me to go that way? And we talked about it, and it was like, nah, I think we'll be all right there, and the point or the lesson learned is, no, next time I'm going that way. We're going, going through that. So
I think the lesson to be learned on the physical inspection is find the right inspector.
Right.
If you need to pay a few more dollars to get somebody that will do a thorough inspection of the property, it is well worth the money. It's much better to spend a lot of money on a good inspector and then walk away from the property because you find all the hidden bodies, so to speak, than to buy the property, go on the cheap on finding an inspector, and then within the first several months see that you didn't uncover those really expensive capital items that need to be done to the property.
Exactly. All right. What do you consider mistake number 3?
Well, mistake number 3 is not having a consensus among the investors about their investment strategy for the property. This is where I've been guilty of personally. If you're buying a property with a group of investors, make sure that those who are in the investor group have the same goals and exit strategy as you do. It's not uncommon. In fact, it happens more often than not that it's too late. You find out that the individuals in the investor group have different motivations for owning the property than you do. Some may want to fix and flip the property, and others may want to have hold the property long term. Some may want to maximize leverage. Others may want to have modest leverage in order to maximize cash flow. And then some may want to refinance at the earliest possible opportunity to take cash out. Others may want to pay down the loan over time. And those are just 3 examples. There are several others. But before you decide to be an investor in an investor group that is purchasing a property, have a meeting with the potential investors. Ask the managing member of the LLC to outline his goals and exit strategy for the property. And also get a feel for whether you would want to be stuck with these investors over the investment life of the property. If you don't like what you hear from the managing member of the LLC, or your gut instinct tells you not to invest with one of the investors in the group because of their aggressive or abrasive behavior in that first meeting, pass on the opportunity. It's much better that you pass on it than regret it later.
No, I think that that makes a lot of sense there. Having a clear understanding of what everybody's objectives are and making certain that everybody's on the page. Because, like you said, a lot of times people have this kind of a sense of an in and out of a real estate investment, which typically isn't the case. It's kind of especially if you're trying to maximize your return, you don't want to find out that you're thinking sell quickly and the market's changed and all of a sudden you lost your opportunity for a big gain. So that's good. What do you consider mistake number 4?
Mistake number 4 is having a lack of cash reserves for unexpected expenses. In fact, the property that I own right now that we're talking from was a property that we purchased because this particular seller did this to himself. You see, one of the biggest mistakes an investor can make is not having sufficient cash reserves available for unexpected expenses. This is really especially true for multi-tenanted office and retail properties. For example, an investor owns a multi-tenanted office building, and he's owned the building for years, and it has cash flowed beautifully. It's been a cash cow. But instead of putting some of the positive cash flow into a reserve account for future expenses, he puts it all into his back pocket. And then one day, one of his larger tenants moves out, and the property no longer cash flows like it once did. Instead, now the owner has to contribute his own cash to keep the mortgage current. He would like to get the vacant space market ready, but to do the tenant improvements and pay a leasing commission will cost him more money than he has in his savings because he didn't put any money aside. The space remains vacant because he tries to do the leasing himself to avoid paying a leasing commission. And years pass with an underperforming property. And the sad thing is it didn't have to happen that way. If the owner had established a reserve account for the eventual cost of tenant improvements and leasing commissions, he would have had the funds to get his property retenanted.
Yep. Do you have any kind of a rule of thumb, being in the financing, when you're looking at budgets, is there any kind of a cash reserve that lenders are looking for?
Well, it all depends on what the size of the property, but generally, you want a little secret. The lenders do not budget for sufficient reserves, in my opinion. What they require and what really needs to happen are completely different. So if you're going to own a property that you know that there's a high probability that a tenant is going to move out in 3 years, or at least there's that opportunity for him to do so, you should find out what it would cost for your tenant improvements to re-let that space, and what the cost of a leasing commission would be. And you'll get some particular number, and it's not going to be cheap. And you divide that by 36 months, and that's how much you should put aside. And once you have that money set aside, you just keep it there. Right. Maybe that tenant decides to release his space. Well, there's another tenant coming along that might move out, or it might be that your roof needs to be replaced in 5 years, or you need to redo the parking lot, whatever it might be. But you should be setting aside a substantial amount of that cash flow off that property the first several years, just as your rainy day fund, until you are, you're flush with cash, and you really don't have to worry about any major capital improvement, because if it happens, you've already set the money aside.
Right. No, that's clearly a casualty of many real estate investors, being underfunded and are undercapitalized and unable to take care of the property, and you end up losing it as a result, or there's a big market turn. So, well said.
Yeah.
So what do we consider mistake number 5?
Well, mistake number 5 is happening all the time right now. It's like almost impossible to avoid, and that's paying more for a property than it really is worth, just to avoid the capital gains taxes. As you know, Darren, one of the advantages of owning commercial real estate is that a 1031 exchange allows the investor to defer their capital gains taxes when they reinvest their equity into a like-kind exchange. And deferring the payment of your capital gains taxes to a later date is a huge advantage to real estate and to real estate investors. But sometimes investors are so eager to not pay their capital gains taxes that they pay way too much for their exchange property. And if you can find an exchange property at a market price, then you need to do a 1031 exchange. But first find out what the capital gains taxes would be if you didn't do the exchange. No one likes to pay the IRS if they don't have to. I get that. I am no different than everybody else. But don't overpay for the exchange property. Sometimes it's actually better to pay your capital gains taxes than to get stuck with a property that will never be a good investment because you paid too much for it originally. And I'm at the point right now, I have a property that we're going to sell probably in the next year. And I just already know, because of where we are in the real estate cycle, that I'm just going to pay the capital gains tax on it, because there's nothing out there at this particular point in time where I could feel comfortable purchasing it for the cap rates that are out in the market today. Now that might change, but I'm guessing that the next one I sell, I'm going to just put that money aside, pay the capital gains tax, hunker down for a year or two, maybe 2 or 3 years, until we go through the next cycle of the real estate market, and then buy then when the prices are in the favor of the buyer, not the seller.
Got it. A the 1031 exchange thing, I mean, I understand the fundamentals and talked to numerous people about it, and you just bring up a point, or at least cued me to think. If you start out in a 1031 exchange, you've got the 45 days to identify the property.
Right.
I've never asked the question, but I assume if you were to identify a property, and let's just say that, rather than overpay for a property, you found a property, but it just didn't measure up, I assume, do you lose the exchange base if you bought a lesser priced property through the exchange process?
Well, you're probably asking a question of somebody who comes to, I would say, is dangerous with the numbers on this.
Right.
I would say to you and to anybody who asks that particular question, talk to your 1031 exchange facilitator. That's what they're there for. And I just know at this point, I go back to the same thinking. There are times when it really isn't in your best interest to do a 1031 exchange if you're paying way too much for that property. In 2007, I bought a property. It was actually my very first property, and it was June of 2007. And I believe if you were to track back to the peak of the market, the last time around, it was June of 2007. So at that time, I overpaid for that property, like everybody else who bought one in that month. And for the next 8 years that I owned it, that property never really cash flowed like it should have. And it's because we paid way too much for it. And if we would have bought it, 2 years earlier, that same property would have cash flowed beautifully. But because we paid way too much for it, it never had a chance. Right. And so we were able to sell it. And because the property appreciated over time, we did okay. We didn't do really well, but we had a 7% internal rate of return on our investment over 8 years, and that's nothing to brag about by any means. But at least it wasn't a loss. But the cash on cash return during that period of time was between 1% and 2%, and that's because we paid way too much for the property.
Yep. I think that's a story that a lot of people are probably on the verge of telling, if you're reading the tea leaves and kind of paying attention to the market, or like you said, just if you're getting ready to sell a property, you may not get back in if the numbers just don't make sense. I get it.
Yeah.
I get it. Well, Doug, this has been, again, another episode of good information, and I appreciate you sharing that with us.
Well, Darren, I really appreciate the opportunity to come on to the Commercial Real Estate Pro Network. I think it's a very good podcast, and my hat's off to you for putting this on.
Well, I appreciate that. And before we wrap this up, what is the best way for the listeners to get in touch with you?
The best way is just to go to my website, which is marshallcf.com. Marshall, my last name, Marshall, cf.com. And on that website, you will see quite a bit of good content for the real estate investor and for the real estate professional. So that's where I would suggest you start. And there's my contact information's all over it. So if you have a question or you want to talk to me in person, my telephone and my email address are there.
Got it. Doug, thanks again for talking, and I look forward to our next episode. For our listeners, if you like the show, share the show with someone you know. It's real easy to do. Just share or click on the share button, and you can share Doug's information. That's all we've got this week. Until next week, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.